Hi everyone, Adam here from Future Set Mortgage Broking. Hope you're doing well. So, Property Finance Insights, where each week we deep dive into a topic of choice, and today we're talking about the 6 elements lenders use to calculate your borrowing power. So one of the most important factors in your home ownership journey is the amount of money you can or should borrow. You want to borrow enough that you can purchase the right property for your needs, yet you don't want to end up out of your depth in debt. Most lenders rely on their own variation of a basic formula to calculate your borrowing power. They generally look at 6 elements of your financial situation to calculate your monthly surplus. Number 1 is your gross income. 2, tax. Number 3, existing commitments. Number 4, new commitments. Number 5, living expenses. And number 6, buffer. This formula gives a good overview of your level of financial security and tells the lender how much you can pay back each month. If you assess yourself based on a similar formula, you can have a realistic idea of how much you can borrow and whether you need to save and prepare a little more first. So the question is, how do all these elements combine to assess your borrowing power? So let's break it down. So number 1, gross income. The lender will look at all your sources of income to calculate your gross income. Sources include your base income, overtime, a 2-year history of any bonuses or commissions, any regular payments from a family trust, and any rent derived from investment properties. If you have children under the age of 11, the lender may also include any family tax benefits A and B. Number 2, tax and Medicare. So your tax and Medicare expenses will be calculated to assess how these costs reduce the amount of your gross income. Negative gearing benefits. If you already have investment properties and incur benefits through negative gearing, the lender will tend to increase the amount of your potential loan. Number 3, your new mortgage, your new commitments. So when calculating how much your new loan payments will cost, the lender will increase the interest rate by up to 3% to create a buffer against any future interest rate rises. Number 4, your current financial commitments. So your ability to pay off your loan will be affected by your other financial commitments, such as ongoing debts and living expenses. Lenders will look at your existing mortgages, credit cards, and personal loans to determine your financial status. Credit cards will be assessed as if you owe the maximum limit, not on how much you currently owe. And the lender will also calculate on a slightly higher interest rate as well. If you are living rent-free with a family member, the lender will calculate in a hypothetical rental payment to allow for a change in your circumstances. You can present to your lender with your own estimate of your living expenses. Your lender will compare this amount to their own calculation of the minimum expense benchmark for a family of your size. They may also analyse your bank statements to determine your monthly living expenses. Either way, they'll use the higher figure to make their estimation. Number 6, the buffer. So the lender will add a hypothetical expense as a buffer against any unexpected expenses that could affect your ability to repay the loan. The purpose of the buffer is to ensure that you are borrowing slightly less than you can currently comfortably afford. So surplus or shortfall. So once the lender has calculated each expense, they deduct these expenses from your gross income. If expenses are greater than your gross income, the result will be a shortfall. If you're living within your income, the result will be a surplus. Extra money can be used to pay off your loan, basically. A surplus is a good first step to securing a loan, although the lender will also take into account factors such as your employment history, your credit score, and your savings before making a decision. You can use this method yourself to calculate your own surplus, so you have a good idea of how you can manage your loan repayments once you purchase a property. This is an excellent exercise in getting a strong grasp of your own budget and working out ways you can make your money work for you more effectively. However, if you engage a good mortgage broker, they will be able to complete this entire assessment for you. All you're required to do is provide all the necessary information. If you'd like me to work out your borrowing capacity, I can conduct a free home loan assessment for you. Simply click the link or button below to book a quick chat with myself, and I can tell you what the next steps are to get started. For now though, have a great rest of the day, enjoy your week, and I'll chat to you soon.